All right, well, welcome to chapter 20, where we'll talk a little bit more about cash flow. So cash flow is not the first time that you've seen this in your accounting courses. So today there'll be a lot of recap and just reminders as far as what is contained in the cash flow statement. So the primary purpose of the cash flow statement is to provide information to readers around where cash is coming from and going to, otherwise known as receipts or payments. And it's to provide that information split out between operating activities, your day-to-day activities, investing activities, and financing. So investing could be, buying capital assets, or investing your actual assets to generate essentially higher returns. And financing when we look at debt and equity instruments and any costs associated with that. Typically, it reconciles it always reconciles the net change in cash between the beginning and ending and provides information of where money comes from and to split on those three categories. It also helps compare the relationship or build a relationship between the balance sheet and the income statement. So it looks at the changes in your assets, liabilities, and various components of equity, and how do they relate with your revenue and expenses that you incurred or generated in the fiscal year. Continuing on, cash is the most important part. You can't operate without generating cash, whether it's, paying employees, buying inventory, building stuff to sell, whatever that might be. You need that cash generation. Excuse me. Typically, a bankruptcy occurs because you aren't generating sufficient cash to cover the cost of your operating your business. Healthy companies are typically demonstrated by positive cash flows from operations. Okay, and typically, if companies are expanding, you may issue shares or borrow bonds in order to generate cash flow to help support operations during a period of growth. And then on the flip side, you'll have interest payments out or dividend payments out in order to maintain those investors. Lately, I'll say more and more organizations, whether it's lenders or otherwise, investors, etc., statement of cash flows is becoming more and more significant in their decision-making process. Statement of cash flow, it helps to assess, how are they generating earnings? Where is it coming from? So it talks about the quality of those earnings. How likely are they able to repay debt? So if you're a debtor, you want to read the statement of cash flows to help understand, are they going to be able to repay any amounts owing? And are they able to generate cash for the long run? Because typically you need to generate cash in order to reinvest in the business, maintain your assets, maintain a stable workforce, etc. So you need to be able to generate cash for long run success. The statement of cash flows helps an organization review their liquidity or solvency. What's its ability or capacity to generate cash, and what's its need for cash based on the activity of the organization. Looking at the cash flow, it helps look at the relationship between various items that they're involved in, and it helps with their predicted cash flow situation, which then feeds their predicted income statement as well. Typically, the statement is based on the changes in the accounts of the statement of financial position, so your balance sheet, over the accounting period. And as mentioned previously, it's broken down between operating, investing, and financing. Operating looks at working capital accounts, so the items that are included in your current asset or current liabilities. Investing looks at long-term assets. Financing is primarily from changes in long-term liability or equity accounts. So in the cash flow world, we'll now move on shortly to direct and indirect method. Investing and financing sections are the same regardless of the method, versus the operating section will be different whether you are using the direct method or indirect, and we'll explain that. So again, recap that we have the three activities: operating, investing, and financing, and that's the general format of the statement. Typically, anyone I've ever seen, actually, operating activities are first, followed by investing. So where you're putting money back into the business or pulling money out, sales and purchases of your long-term assets. And then you'll follow it by finances. It's important to note that you would not net inflows and outflows. So say you purchased assets and sold assets in the same year, you would actually have separate line items on the cash flow statement. So you'll look at, investment in capital assets for the organization and proceeds from sales of long-term assets of the organization. So they would be separate. The statement helps provide reconciliation between the beginning and ending cash. And this is the important piece, is what the end result should be. So if it does not balance, you've missed something, because the power of balanced accounting entries is that if your statement of financial position, your statement of financial activities, so your balance sheet income statement, if they're reported properly, your cash flow will reconcile. So if it doesn't reconcile, you've missed something somewhere. The direct method identifies the sources of operating cash payments and receipts. So we'll explain more of what that is shortly. This course will focus mostly on the direct method versus in previous courses, we might have used the indirect method more often. And reminder that the direct method, the difference is only in the operating section. The direct method is typically favored, especially in companies that have shares trading, etc., because it's more consistent with providing, how do you estimate future cash flows? Because the direct method identifies, what do you expect from customers? What do you expect to send to vendors for your inventory or for your supplies? How much are you expecting to pay out to your employees? Things like that. So it gets into more detail to provide sufficient information to help support those future estimates. So those cash receipts and payments are typically more useful in helping with prediction than just looking at changes of current assets or changes in current liabilities, and provides you something that you can be a little more concrete on. Any incremental cost of accumulating, cash receipts and payments data is not usually significant now, because we have accounting systems. You might say, oh, how can I track all of these moving parts? Well, in accounting systems, you can typically report very easily. IFRS and ASPE both encourage, but do not require a direct method. And the indirect method may be easier. So the indirect method is easier, I'll say. You can do it directly from your balance sheet and income statement. You don't need any additional information. Versus the direct method, you will have to do a little further investigation into your accounting systems to get the sufficient data. So it's not required. So use of the direct method is the exception. Indirect method has been used in the past, and it's much more familiar for most entities. So again, as I said a moment ago, indirect method looks at just the changes in net income and cash flow from operating activities. It's very easy to develop, and it just starts with net income and adjusts based on those changes of current assets and liabilities. So when you're looking at the format of the statement, specifically in the operating section, typically you'll have your cash receipts from customers. So, what you received from customers, whether it was in advance or paying off AR or in-year sales, doesn't matter. It's cash receipts in that fiscal period. You'll have cash receipts from other revenue sources. You might have payments for your suppliers for any goods and services. You might have payments to or on behalf of your employees. So it's typically anything around compensation. And then you might have cash payments of income taxes. So those are kind of the 5 key categories, but there could be some other operational activities. So when you're looking at developing the cash flow statement in this direct method, the cash flow from operating activities shows the ability or the extent of which the customers are able to cover the payments to suppliers and employees. So ideally, you should have an excess of cash coming in from customers above what cash is going out for your supplies and for your people, your labor costs associated with providing that service or good. So hopefully you'll see that. The users of your financial statements, they can then, analyze, the reasons for the operating cash flows. So they'll look at, why did you spend this much or that much? Where did the cash come into, to and from? And so they can make, reasonable assumptions on whether you are sustainable and how likely are your activities of your business repeatable in the future based on that information. Another part, it shows, I already said that first bullet. I just realized it's a double. So it shows the extent of receipts from customers able to cover suppliers and employees. Okay. How you calculate some of this is the cash received from customers. We'll look at the net sales. We'll add or subtract any change in AR, and sometimes you'll consider bad debt adjustments as well. Your cash paid to suppliers, we'll look at your COGS or cost of goods sold, plus or minus any change in inventory, plus or minus any change in AP for those suppliers. For other operating expenses, we'll look at other cash operating expenses, plus or minus any change in prepaids, plus or minus any change in accruals. Okay. And then cash paid to employees will be your wage expense, plus or minus any change in salary or compensation related accruals. So you can always tie them back to your other statements. Investing, again, we're looking at our long-term assets. It shows, are we maintaining the existing capacity? Are we investing in our capacity? What types of assets have we purchased? Have we invested in new technology? Have we disposed of any existing assets in order to generate cash, et cetera? So the investing section kind of gives you an idea of what they are investing or pulling from their invested assets to support the activities of the organization. In the investing section, sometimes it's very helpful to look specifically at the T account. So looking at, what assets came in as purchased and what assets removed as sold, because you do need to disclose that information separately. And remember, if there is a gain or loss reported on the financial statements, on the income statement, that is part of your cash proceeds. So if there's a gain, it's because proceeds were greater than net book value. So on your cash flow statement, the cash proceeds will be exactly that. So it'll be the net book value removed plus that gain, or subtract that loss would be your cash proceeds. And remember, if you buy assets with shares, it's not cash. Okay, so you would not include any assets that are traded for shares. On the financing side, we'll look at any changes that occurred in the organization's capital structure. Did we increase or reduce the claims of any creditors? So, did we have any changes in our liabilities, our bonds, our debts, our mortgages, whatever we might have? Did our share investments change? So that would be reported in the financing section. Typically, the financing methods are related to the types of assets acquired. So sometimes, say you issue more common shares, is that to help support operating, or is it to help support an investment, say, in a new manufacturing facility? So you can see relationships on that statement of cash flow. Again, in the financing section, you might want to look at T accounts to determine when dividends were paid. So you have to look at the cash side, and you only include shares sold for cash. So just like on the asset side. Some of the differences between, how you classify cash dividends and interest under IFRS and ASPE. So when you pay them under ASPE, if it's recognized in net income, it's an operating cost. If it's charged to retain earnings, it's a financing cost. Under IFRS, you have the choice. For any interest and dividends received, it's operating under ASPE. And under IFRS, you can choose between operating or investing. Typically, there'll be extra disclosures. So where there's significant non-cash investing and financing activities, so what you did trade, $10 million worth of shares for $10 million worth of assets, but therefore it's not on your cash flows, but perhaps it's a significant change in your balance sheet. So you would disclose that. What policy do you have in place as far as what determines cash and cash equivalents? Is it, anything held in short-term less than a 60-day, period for short-term investments, et cetera. Is that cash and cash equivalents? You'll make sure that there is that reconciliation of cash and cash equivalents to the balance sheet, so your statement of cash flows will match. And IFRS has additional, as always, more strict requirements relating to disclosure. So you'll have to disclose additional details around income taxes, any interest and dividends in or out, paid or received, and any restrictions that you may have on cash equivalents. One term that you'll hear talked about in this chapter is a free cash flow. So this is a non-GAAP measure used by companies, and this helps indicate, what's their discretionary cash available for new investments. So that could be paying dividends, it could be paying off debt, it could be repurchasing shares, it can help with liquidity. So that's your free cash flow, and that is calculated by your net operating cash flows, less any capital expenditures to sustain your current level operations. So any investment in capital that is required to maintain your current level of operations. And this is a good note. Any companies with significant free cash flow have a strong degree of flexibility. So they have more ability to make decisions throughout time as far as where they want to invest their cash. They can typically take advantage of new opportunities. So if a new business opportunity arose and they have a high free cash flow, they can typically respond and take advantage of it without impacting their current operations. This is a good position to be in. And that's kind of the general gist of the chapter. Hopefully this helped.